Welcome to the Fintech Founder Journey, where we explore great fintech products, great fintech businesses, and great fintech leaders. I'm your host, Mike Scott, and I'm also the co-founder and CEO of Nona Digital, an expert firm that accelerates product development for fintech and blockchain scaleups. In today's show, I'm joined by Michael Spencer, who is the CEO and co-founder of SmartMoney, and we'll be talking about his journey and the opportunity that exists in fintech in rural Africa. Today's episode is sponsored by Nona Digital. Working with us to create or accelerate your fintech product means you get access to our expert product teams across design and engineering that have been building products together for a very long time. You get the benefit of a studio that is large enough for no key person dependencies to exist, but small enough so that you're always close to one of the principals. And you get the benefit of our reusable component library, which basically means we're often able to build your product faster than anyone else could at a comparable standard. As one of our clients said, Nona is the type of business that paints the back of the wardrobe, because if you want to be the best, that's the sort of thing that you do. To get in touch with one of our principals or myself, head over to nona.digital to book a call directly. And now on to the show. Today, my guest is Michael Spencer, who's got a good story to tell. Michael's career has seen him move from VP of the Bank of New York to director at Credit Suisse Boston to director at Goldman Sachs to CTO of ASMALLWORLD. And all of this experience has led Michael to his focus today, which is an interesting one given his background, which is as the CEO and co-founder of SmartMoney. And SmartMoney is an Africa-based fintech that is harnessing the explosive growth of mobile phone usage across Africa. Its approach is unique, and we'll get into that, in that it's focusing on rural market entry to gain network effect advantages in the highly contested urban markets. It's a very interesting approach, and this is what we're going to be exploring. Welcome, Michael. It's great to have you on the show.
Thank you, Mike. It's a real honor to be here. I think this is a very important show, and you're spotlighting some very impressive founders and fintech businesses, and there aren't many platforms doing that today. So great to be here.
And you're one of those impressive people. So let's start right there. So, look, you're a sort of Wall Street guy, US guy, very respectable career with some very big names, but you find yourself focusing on rural Africa and an opportunity there. So just quickly, let's begin with the backstory. How does a guy like you find himself focusing on a rural African fintech startup? Talk to me about how that all happened.
It's a great question because my resume would suggest that I'm a Wall Street guy, as you said. But the truth of it is I was born in London and raised on a farm in Western Canada. And my chores included feeding pigs and designing relational databases, which is an odd combination. But my father, who ran this small hobby farm, was, during the week, a management consultant. And, he designed very complex computer systems. This was back in the days of mainframe computing, before the PC was even invented. And as a 13-year-old kid, I ended up getting roped into helping my dad with his business. And so he trained me on mainframe computing and DB2 databases. And so I was, working the big iron before the PC even really was around. And that was a really great way to get my career launched.
I reckon, so I think on your LinkedIn profile, that's got to be your tagline, like, I feed pigs and design relational databases. I think you'll get a hell of a lot of attention. But cool. So certainly not what it said, like certainly not what your profile would suggest, as you have just said. So then what happened? Then your career developed, and talk to me about how that happened and then how you find yourself focusing on rural Africa.
Yeah, no, it's great. Nothing about my life has been, the standard journey at all. As I said, I was living on this farm until the age of 18 and working with my father. And it was a great apprenticeship, really, because he taught me not only about modern computing and, sort of enterprise computing, but also how to conduct myself as a business person in a professional setting. And so at the age of 18, I left home, I left Canada, moved to London, England, and became an independent management consultant. And I found myself managing teams of 40-year-old British professionals at places like Lloyd's of London and British Telecom. And while I had the sort of technical chops for the job, I was an 18-year-old kid and really just was way out of my league in terms of the politics and I'll never forget how one day I was wearing a polo shirt, I think, to work, and I had this little yellow horse on my white shirt, and one of my 40-year-old employees, said, I think you've got some egg on your shirt there. This is the kind of abuse I used to take on a regular basis, and they used to call me the colonial. So yeah, this is sort of how I got started in kind of the corporate world. And one thing led to another. I found myself in New York and landed on Wall Street and spent 15 years there managing increasingly large and complex financial services systems, which was an absolutely fascinating experience. I mean, I really went through a full, sort of tour of duty, I guess, across the financial services space, managing increasingly large and complex computer platforms. And by the age of 31, I'd pretty much had enough of corporate America. I'd reached a fairly senior position in these large companies and really was finding it to be more political, not so creative anymore. And ended up kind of shifting into the startup scene in New York. Started my own startup business. And as you said, I was working as a CTO for a social media company called ASMALLWORLD for a time. And during this period, I found myself randomly dating a Kenyan lady, wonderful woman, who I met on Match.com. Again, totally random, right? And, after some time, she invited me to visit her family in Western Kenya. And I'd never been to Africa before. And so I thought, yeah, let's go. This will be a fantastic adventure. So off we went, and it wasn't your typical tourist experience, right? We weren't staying at 5-star hotels and safari lodges. We went straight out to Webuye in Western Kenya, a very remote village with no paved roads or electricity or running water and children everywhere. And it was an incredibly transformative experience for me. Her 92-year-old grandfather gave me an honorary goat. I was incredibly moved by the whole experience. I think I decided right then and there that I wanted to do something more meaningful with my skills and experience. I didn't really know what it was. But on that same trip, I encountered M-Pesa, which some of your viewers may know was the world's first implementation of mobile money brought into Kenya by Safaricom. And this was, 13, 14 years ago now. So it was still pretty early days for mobile money and M-Pesa, but it was already happening. And I observed people using basic feature phones to transact, make payments and do financial transactions. And that really blew me away because we weren't doing anything like that back home in America at the time. There was no Apple Pay. Nobody was using phones to do financial transactions. So, given my background in finance and tech and this sort of interest that I had in possibly doing something in Africa, it all sort of came together. I ended up back in New York after that trip. Just talked to some colleagues, some friends in New York. Just floating, this idea. I wanted to do something in Africa with mobile money. And I met up with a team of guys who all had some different business activities happening in Africa. They had different contacts and, a whole range of things, real estate, all kinds of different things. And so I somehow got involved with this group. And it was funny. I remember a conversation. I said, well, what am I going to do over in Africa? And they all kind of looked at me puzzled. They said, I don't know. You got a background in technology and finance. Figure it out. And that's kind of how it started. That's really how it started. We went back out there and the journey began.
So that's a super cool story. And it's that immersive experience in Africa, you can't explain it. You have to live it. I'm from Africa. I've lived there my whole life, bar the last 2.5 years. South Africa, which is quite different to Kenya, the same continent, vastly different environments. So they're both Africa, but they're kind of not. You had this experience, and I don't know if your thesis arrived at that point or if this thesis has developed over time. But when we were talking in the pre-interview, effectively you have a thesis which you're trying to execute on and prove through smart money. This thesis is roughly stated as, in my words, that the big opportunity in Africa is in the rural areas. Talk to me about your thesis. Talk to me about, we all hear about the fintech opportunity in Africa, so I won't ask you to sort of talk about it in the broad sense, but I do want you to talk about what is the fintech opportunity in Africa in the context of seriously rural Africa, and why do you think it is the big opportunity? Tell us about your thoughts.
Sure. Well, let me explain first why I think it is the big opportunity, and I can explain also sort of how we stumbled upon it, because it's not something I think that most people think of when they think of fintech in Africa. People generally don't think of rural; they think of the big cities, smartphones, crypto, blockchain, and that's really not the opportunity that we're focused on. Rural is very interesting because of the demographics and dynamics of the African continent. We're talking about a population of 1.4 billion people. 60% of these people are living in relatively remote and isolated rural communities. These communities are vastly underserved and mostly unserved by modern financial services products. And that's not well recognized. If you look at GSMA studies or, other research documents, they don't tend to differentiate between rural and urban. They just lump them all together into big, impressive statistics. So one doesn't see that urban is much more heavily serviced than the rural portion of practically every country on the continent. And there are good reasons for this. The barriers to accessing rural are quite tremendous, as we've learned over the years. And there's also this sort of broad, in my opinion, misperception that there isn't really a commercial opportunity in rural. In fact, what we encounter a lot is a widespread bias towards rural in general. People think of it as a place for churches and charities, not for businesses. And if you are running a business, well, you must be exploiting people in some way, right? That's sort of the way people think of the market that we're addressing. We don't see it that way at all. We see it as a market with 800 million people who all have some money. Some have small amounts, many have small amounts, but some have surprisingly large amounts. And they don't have access to even bank accounts. So people are keeping money in tin cans, under mattresses. Women are wearing it under clothing. It's very dangerous. They lose a lot of money. There's a lot of theft. And it's logistically very difficult even to save money when you don't have any place to actually keep it. And so there's clearly demand for financial services. So, call me silly, but, we go where the customers are and the competition is not. And that's rural Africa. It's a very, very exciting opportunity. But wait, there's more. There's more. Because if you consider that the way the African culture works is relationships are paramount. I think if you go to any African country, you'll find that relationships are very, very important to the population. And this is a beautiful thing, of course, right? People have very large networks of friends and family, and the relationships are extremely meaningful. And this is very interesting in the context of financial services, because when you really stop and think about it, financial services is a network application, right? It's a network application. The utility of the service comes in large part from the number of customers on the platform who you can transact with. It's much like social media, right? If you were the only customer on Facebook and you had nobody to share your content with, then Facebook would not be very useful to you. But because your friends and family are also on Facebook, you have people to communicate with and share photos with, and therefore it has utility. Well, financial services is very much the same. If you have people on a financial services platform who you can transact with, send money to, receive money from, and so forth, then you have a very useful service. And so the fact that Africa has such large social networks plays very well into the phenomenon of network effect businesses. And so if you think about it, every urban customer in Africa will by nature, have a very large network of rural friends and family. And this has been our experience. If you meet urban people, you employ urban people, you find that they have vast networks of aunties and uncles up country, as they say, in the villages. And most of these people, the vast majority of these rural people in their network, are not on any formal financial services platform. And so it's very difficult for them to transact with those people. What type of transaction would they do? Well, maybe they want to send money for school fees to a cousin, or, send money to their grandmother for a medical bill, or pay a utility bill, or just make a small loan. All kinds of these transactions occur within these social networks. But the rural portion of their network is largely blocked from this type of modern financial activity. So that means any financial services provider who acquires those rural members of an urban customer's financial network, or social network, I should say, can provide a utility advantage to the urban customer that no other urban competitor could possibly match, unless they too have those same rural members of that urban customer's social network, which they don't. If they did already, then there wouldn't be an opportunity there. So it turns out that rural is not just an incredibly compelling commercial opportunity in its own right, but it's also a secret backdoor to acquire urban customers in comparatively highly contested urban financial services markets. And so we see it as just an incredibly strategic place to be.
So that's super interesting. And I guess two things are jumping into my head. One is positive, and that is around, it sounds to me like your customer cost of acquisition would be very, very low, which we've actually spoken about. So I know it is. The more sort of challenging thought that I'm having, which I want to ask you in a question format, is if you've hung around blockchain or crypto, you've heard the word unbanked just so many times, right? It's you go to any crypto conference or you speak to any person in crypto, and I'm kind of rolling my eyes a bit because the concept is amazing, but I just get sick of hearing it all the time and not seeing much real execution, which is banking the unbanked. Blockchain is the infrastructure that's going to allow us to bank the unbanked and bring financial services to the unbanked and the rural people. And just to be clear, I agree that it will, but I'm just not really seeing too many real use cases that are actually being adopted at mass. What you also hear is cross-border payments, cross-border remittances, people working away from their villages and their countries and getting absolutely fleeced by sending small portions of money back to their family, which is very sad. Rich get richer, poor get poorer. My question I'm leading up to here is, you're effectively trying to do the same thing. You're trying to bank and help and facilitate these very rural, unbanked people. What are you doing differently? What's different about your platform or your technology or your approach or your strategy that is different to all the noise that is out there at the moment? How have you, maybe I should have sort of said this at the beginning, but maybe just to paint the picture to the audience, Michael's business has got 200,000 registered customers. They've put multiple millions of dollars, I think about $5 million worth of transactions through the system. And they've got a $4 customer acquisition cost. So there's traction here. There's serious traction. My question around this is, why is it working for you? What are you doing right? What's different about your system to all the noise out there that says we're going to bank the unbanked and then that's the end of that? Talk to me about like the secret sauce, if it isn't that secret, or the differentiating factor or the USP, whatever you want to call it. Go for it.
Yeah, thanks, Mike. Well, that's how we started 10 years ago too. We said, look, they're unbanked. Let's go and bank the unbanked. How hard can it be? And in fact, just to sort of conclude my little introductory history there, when I went back to East Africa with that group of colleagues I mentioned earlier, it was once again a random encounter that led us towards the rural opportunity in the first place. We happened to be in Tanzania, in Dar es Salaam, at a restaurant, talking about mobile money. And a cotton ginner, a Tanzanian cotton ginner, happened to overhear our conversation, and he came up to our table and introduced himself and said, I heard you guys talking about mobile money. I own a cotton factory in rural Tanzania, and none of my farmers are using this mobile money stuff. And I said, oh, that's funny. From what little I know, most rural people don't have access to bank accounts. And he says, yeah, that's true. We have to pay everyone with cash, all our farmers, right? And I said, well, do they have phones? He says, yeah, as far as I know, that most people have phones. And so why are they not using this stuff? And he says, I don't know. Why don't you come out to my cotton factory and we'll go and interview the farmers? And so this led to a year of my life where I actually moved around rural villages in northern Tanzania with this cotton factory owner, with him translating, from the local language into English for me, interviewing hundreds and hundreds of farmers. And what we discovered was that, as I said, people have money. There really is an opportunity here. They don't have bank accounts, and they do have mobile phones. And so it seems like it would be a relatively obvious thing to bank these people. And I think this is pretty much where the world is, right? People think, okay, obviously people need financial services. They've got phones. How hard can it be? Well, it's actually very difficult. It's very, very, very difficult, and much more difficult than we certainly realized when we started down this path 10 years ago. Difficult for a whole host of reasons. The first one is that the technology is actually probably the least important aspect of the solution. It's a necessary aspect. The technology is very, very enabling, and without it, we would not be able to provide financial services at all to these communities. So the mobile phone is really a key component. But the first thing that I think has to be recognized is when we talk about a mobile phone in rural Africa, for the most part, we are not talking about smartphones. Most people, the vast majority of people, cannot afford smartphones, nor can they afford very expensive data plans to access the internet using a smartphone. So we're not talking about a population of people that can benefit from crypto apps and, fancy, internet-based services. They're just not able to access them. They simply can't afford them. So right away, if you're looking at a business that's offering a service or a product through a smartphone app, they're not targeting rural because the rural customers are not going to access that app. So right away, you've got, a challenge to overcome. The only way to really address this is to meet the customers where they are. And where are they? They're using feature phones, the type of technology that we all used in the 1990s, flip phones, right? And you might recall those phones did two things, voice calls and SMS messaging. Turns out SMS messaging uses another protocol below it called USSD. So every GSM phone, since they were invented in the 80s, supports USSD, and through that you can actually deliver fairly useful text-based applications. They aren't anywhere near as fancy as a smartphone app, but they do allow interactive functionality, and through that you can deploy basic financial services products. So that's the key thing. You must design your customer interface to meet the minimum operating requirements that exist. So forget about smartphone apps. So the first big obstacle we encountered through that year of interviewing farmers was price. The most consistent response we received when we asked people, why aren't you using conventional mobile money, was it's too expensive. For the most part, people understood the brands, they understood the concepts, they understood the benefits that were being presented, but they said it was just too expensive. And this was actually masking an even more fundamental problem. And to this day, I believe this problem hasn't really been addressed. And it's a question of use cases. So if you look at conventional mobile money and the way it's priced, the fees that are charged for sending money from one person to another are calculated as a percentage of the amount that's being sent. And it's not a linear percentage. So if I send to you a large amount of money, the fee as a percentage of that amount is small and reasonably affordable. But as the amount you send gets smaller and smaller, the fee as a percentage of the amount you send gets higher and higher and higher, to the point where if you're in, for example, Uganda, and you were to use MTN mobile money to, buy a 30-cent bottle of Coca-Cola, you're paying approximately 30 cents in fees to MTN for the privilege of using your phone to make that transaction. Well, I can assure you a farmer who's living on, $1 or $2 a day is not going to pay an extra 30 cents to buy a Coca-Cola when they could simply pull cash out of their pocket and pay for 30 cents less, right? So very quickly we discovered, hey, wait, we're not competing with mobile money providers here in rural. We're competing with cash. We're competing with cash. And cash is always a free transaction. It might have challenges, security, and so forth, but it's always free. And when you're talking about a rural market context where there isn't a lot of excess income for luxuries and things of this nature, people are going to find the cheapest way to do everything they have to do. And so it turns out that before you can even talk about offering benefits from digital, you must eliminate the frictions of your solution relative to cash, or come as close to that as you possibly can. And price is number one. So the very first innovation we introduced when we brought smart money into rural Tanzania 10 years ago was that we offered it free of charge. And not because we're a charity or we're trying to save the world, but because cash is free of charge. There's no transaction fees on cash. So we had to offer our service free of charge. And we naively thought, okay, we're going to build our own digital money platform, which we did in a very short time. And we're going to offer it free, and everyone's going to come running, and they're going to sign up, and we're going to have millions of customers. And it didn't work. Practically nobody signed up. And we couldn't really understand why. Now, we had also a very interesting revenue idea, too, because obviously if it's a free service, how are you sustaining the cost of this, rolling it out to millions of rural people? Well, we needed revenue from somewhere, and so we drew from the example of social media, right? These are called cross-subsidization models, where one group of people can use the service free of charge, us, the public, right? If you look at Facebook, none of us are paying for Facebook or Google or Twitter. So how do these companies make money? Well, they make money by charging another group of customers, right? So these would be the advertisers or, other stakeholder groups, but mostly advertisers in the case of social media. So the revenue they make from one group subsidizes the free service they offer to another. And so we said, okay, let's do that, right? Let's make it free to the farmers. And wait, who are we going to charge? We can't charge advertisers. There's no advertisers out here. So what we did find, there were cotton factories, as I mentioned before. That was really my entry point into rural Africa, was through cotton factories. And we discovered some phenomenal realities. These cotton factories are massive. If you've ever visited a cotton factory in Africa, it's really worth doing. Absolutely incredible factories, trucks moving everywhere, just a massive amount of capex. And these companies are paying upwards of $10 million US a year to, say, 200, 300,000 cotton farmers. And they're doing this with cash. Well, if you've ever seen, $200 of Tanzania shillings, you'll know that it's a stack like this, right? So what does $10 million of Tanzanian shillings look like? Well, so this is what we did. We went around and interviewed these CEOs of the cotton factories and asked them, how exactly are you paying your farmers? And I'll never forget one story. The stories are absolutely amazing. Every factory has this incredible process of making payments. But just to give you a sense of how crazy it is, one guy says, yeah, well, we organize a convoy of semi-trailer trucks to drive cash across the country from the central bank in Dar es Salaam to our branch out here in Mwanza. And from there, we organize a small plane to fly into Mwanza, and we have a bunch of guys with machine guns that move bales of cash into the plane. They then fly over the fields, and they drop these bales of cash out of the plane onto the field. Then we have another set of guys in saloon cars zooming across the field, also with machine guns, picking up the bales, driving them out to the many, many buying posts where they break up the bricks and hand them out. And these guys hide them, in all kinds of places in the buying stations, right? And I spent a lot of time at these buying posts, so I know exactly what they look like mud brick buildings with little tiny weigh scales, not exactly a secure location. So I said, oh my God, how much is all this costing you? Airplanes, security guards, not to mention all the middlemen who I'm sure must be pocketing half the cash. We started tabulating this, and we found that, on average, these factories were losing 15% of their annual turnover just in payment inefficiencies. So we said, aha! What if we were to get rid of all the cash, the airplanes, the semi-trailer trucks, the AK-47s, and instead give your farmers a free-of-charge digital wallet they can access from their GSM phone? Then you, the cotton factory, could pay them on their phone, and you could afford to now pay us a fee for that. that would be much less than the 15% you're currently paying on cash. Plus, you'd be increasing security for your farmers, your employees, and so on and so forth. And you'd have,
which is really clever, because as you said, you've now removed the friction of cash. You've made it free to the end consumer, but you figured out your monetization model, which is from the service providers, which in this case are the employers who have to pay this huge amount of numbers, which is really smart, because that's where mobile money has, I think, made it difficult, right? Is they're charging the end consumer, which is really important. So I love that, and you painted a really colorful picture there. And again, having come from Africa and traveled around Africa, I can totally believe every single word of it, and it's just so colorful. It's hard to explain. So look, that's super interesting and very sensible and logical. I guess where I want to move to now is raising capital on this venture. So, in our pre-interview, you said something to me which really is true, and I'm experiencing the same thing, which is everyone's just talking about payments. And there's more money in fintech than I've ever seen before. And if you just go to Crunchbase or read any journal, you'll just see records of decacorns and unicorns, and 3 out of 4 VC dollars are going into fintech, and people are raising at these crazy valuations, and it's really pretty frothy at the moment. But it's not pointed at exactly the niche that you're going for. So you've raised some capital to date. I think, if memory serves, it's about $2 million US so far. You want to raise some more as you begin to scale out and really try and put the accelerator down here. What is your experience of the capital market at the moment through the lens of a really niched startup or scale up, however you identify yourself? How are you finding the capital markets? Are people understanding what you're doing? Speaking of Silicon Valley or the UK or sophisticated investors, do they get what it is that you're trying to solve? Do they understand it? What's your experience of the whole capital market situation at the moment?
Well, I thought I was a banker, but I've discovered that I'm in the education business, and that applies not only to our customers, but also to investors. And why do I say that? Well, yeah, I think what I've witnessed in all the years we've been raising capital for smart money is that there's quite an understanding gap between the gatekeepers who are making key decisions about investment in Africa and the realities on the ground. And the reason is because most of the people who are working at the venture funds haven't really had much opportunity, if any at all, to spend time on the ground in Africa, let alone rural Africa. And I know this from talking to many, many people at different funds around the world, in both the development sector, the DFIs, and also in the sort of commercial sector. And they'll concede that, rarely do they have a chance to actually travel to any of the countries where they're investing. And if they do, they fly into the cities, they stay in a nice hotel in Kampala or Nairobi, and, they invite a bunch of local entrepreneurs poolside, they have some good drinks, and then they have to jet out again. So they don't even really get a chance to see the surrounding city, let alone drive 6 hours out into the country and spend meaningful time out there experiencing the actual market context that is rural Africa, where 60% of the population is living. And so you have this situation where the people making the investment decisions don't really have enough market understanding from firsthand experience to really appreciate the kinds of challenges that the rural community is facing, and why some of the products that are being financed are really not meeting their needs. So what ends up happening as a result of this sort of knowledge gap, you find that there's kind of a pack mentality, right? Where the venture funds are all sort of chasing the same type of investments. They're going into the same markets: Nigeria, South Africa, Kenya, Egypt, right? And Ghana is starting to get a little bit more attention now. These countries are practically where all the fintech investment is going. But, secondary markets like Uganda or Tanzania are kind of off the map, right? So you have this kind of geographic concentration of investment. And then, as you said, there are certain categories that are really hot. Payments is really hot, right? Cross-border payments is hot. Also, you see historically credit and lending businesses have been also very popular. you don't see so much of interest in savings or investing in some of these other financial services products. And, again, when we started 10 years ago, I too thought payments was the answer. It's got to be payments. Let's go and do payments. And as you just heard me explain, that's where we started, right? We tried to figure out, how do we give our customers a digital wallet so they can make payments? How do we give agriculture companies like cotton factories a payment solution? Well, the solution that I described to you, offering a free of charge service to farmers, cross-subsidized by fee revenue charged to cotton factories, sounds like a wonderful idea. Didn't work at all. And today it's known as ag value chain payments. And the model that I just described to you is pretty much the model that most companies that are in that sector are still pursuing today. Why did it not work? It seems so obvious that it should, right? It didn't work because there's a fundamental barrier to innovation that exists, I think, across Africa, but especially acutely in rural Africa. And that is trust. Trust. People simply don't trust innovation. And they don't trust it if they don't understand it. Just like you and I wouldn't trust something new if we don't understand it, right? So people have to understand the new thing in order to evaluate whether the benefit outweighs the risk, right? The risk of losing the familiar and the comfortable. So the real question the real challenge, I should say, that we've had to learn how to address over these last 10 years is not how do we develop a sexy, technology stack. It's how do we bring understanding to entire rural communities at scale, at a cost point where this is actually a profitable commercial business. Now, consider the challenges of this, right? You're dealing with vast populations of people spread out over huge geographies. The people themselves have no mobility themselves. So if you set up a school in the center of a rural community, nobody will come because it's a 2 or 3 hour walk to get there and a 2 or 3 hour walk to get home again. So in order to bring understanding to the people, you literally have to go to the people. And okay, let's say you're able to do that. You reach your rural customer at the top of the mountain only to discover that they don't speak English. They don't even speak any sort of familiar language. They only know their own local language, which means that the person who's going to reach that customer has to be from the same local community. Now you're starting to kind of get a sense of the magnitude of the challenge. To build trust, you got to build understanding. To build understanding, you got to field a local team of people that you've recruited, trained, and mobilized to go up the mountain and actually train these customers. Otherwise, they're not going to understand how they benefit from the service, and if they don't understand, they're not going to use it. And this was the very, very hard reality that we encountered 10 years ago in Tanzania, and that we've been all these years working to address. I'm happy to say we finally now have a model that can achieve this goal. We can bring meaningful, sustainable behavior change to entire communities of people where they not only experience the benefit of using a digital wallet and saving and investing, but 50% of the customers that go through our onboarding process continue saving weekly for at least 2 years after the training has stopped, which is the amount of time that we've actually been monitoring them. These customers are saving 15% of their income, which they then invest in new income-generating enterprises. For example, they might buy new land, expand a farm, buy inventory for a shop, perhaps educate a child. Ultimately, all of these investments realize more income. And we found that this is really the use case that is probably the most relevant to driving activity levels of financial services. And so this is a really key thing to understand. What we also have found through all of our work is that activity is really the metric that people need to be looking at. And too often I find that that's not even talked about. People talk about customer growth as if signups are all that really matter, right? Oh, we increased the number of customers by 600% in the last 6 months. Well, how do you define a customer, right? Is a customer somebody who signed up for a service and never uses it? Or is a customer somebody who's using the service frequently enough that they have gained trust in this new service? They've gained sufficient benefit that they trust it. And they trust it and use it enough that they're also generating sufficient revenue for the company that this is a sustainable service offering, right? That to me is, I think, a more meaningful definition of a customer. And so activity has to be the basis by which we qualify what is a customer. And this is also something that's been very interesting to me, is that we found that if a customer is not active with a digital account at least once every 2 weeks, they're not really generating enough engagement to build the trust that leads to this type of sustainable behavior change. Why is that interesting? Because if you look at mobile money figures, until relatively recently, a mobile money customer was considered active if they had one transaction every 90 days. That's not very active, right? And it's certainly not active enough to generate behavior change. They've recently, according to the GSMA anyway, reduced that now to 30 days, but in our experience, even that's not really a level of activity that is sufficient to generate the threshold that we're talking about. So what we found is that payments doesn't generate that level of activity where customers are really learning the benefit and trusting the platform. Payments is not a use case that drives this type of onboarding into a new formal financial services solution. Instead, what we found is savings is a much, much more effective way of driving customers towards this type of innovation. And why is that? Well, consider what is probably the most common need among African people and probably worldwide. If you ask somebody what do they want, more often than not, they're going to answer with, I want better healthcare, or I want more education for my children, or I want better housing. Well, all of these things cost more money, right? So really what they're all saying is, I want more money. And some people will just come out and say that, I want more money, right? So in order to lift themselves up, they all want more money. Well, there's really only two ways you can get more money, right? You either borrow and invest, or you save your own capital and invest your own capital. This is the only way people get more money, right? They have to invest in something that's going to realize for them more income. They might invest in their own education. They might invest in a new business. They have to invest money to make money, right? It takes money to make money. That's what we always say. Well, historically, credit has been the answer for this, right? Let's just give more rural people more loans and they'll invest that money and make more income. The reality is that doesn't work well. Interestingly, Finca, which is the largest microfinance company in Uganda, been operating for many years, they found that 90% of their loans to their customers was going into consumption, not into investment. Meaning people were using the loans not to build a business or educate or, get more farmland or anything that would realize increased income. Instead, they were, spending money on, medical expenses, weddings, burials, girlfriends, whatever it happened to be. So they weren't generating new income and they weren't able to repay the loans. They quickly default. They end up in debtor's jail. They lose property. And it's really not been a very effective solution by and large. But if a customer could save their own money and invest that money in new income generation, they can actually get more income for themselves. And we've found that is the most motivating thing for rural customers.
Well, unfortunately, we lost Michael's connection. He must be having some issues on his side. So we're going to have to end this episode short, but we were just about to close up anyway. Fascinating discussion about the opportunity of rural Africa in the fintech space. And we'll have to get Michael on again to share the rest of his message, and we can check in on the progress. So thanks for listening and for making the time to tune in. I hope it was valuable to you. To me, it certainly was. There was a whole lot of information there that I just was not aware of. And it just really reinforces that there's just a massive opportunity in the fintech space in Africa. So thanks for listening to the show. And if you'd like to discuss your fintech or blockchain project with us, you're welcome to book a call with one of our principals at our website, www.nona.digital. And I'll be back next week with another episode to explore the FinTech Founder Journey. Cheers.